Hello, this is Steve Schwartz with Market Traders University, coming to you from the virtual studios of Market Traders TV. Once again today, we're going to be looking at the PowerShares DB Agricultural ETF. In the last video that I posted, as you may recall, I bought 600 shares of the DBA. Here's my account in the Trade Monster application. Great application, very easy and user-friendly. But nonetheless, in my account, here's the price. This is a slide, though, I might say, so you can buy it or you don't buy it. But nonetheless, I bought 600 shares of DBA. This is what I've gained today, albeit, though, I purchased it on this spike, this little peak above the moving average. That moving average is a 10-day exponential moving average. Then the following day it tried it again, backed off, did not concern me whatsoever, because I know and I'm aware of the fact that once markets start peaking above and they have 2 consecutive days, this represents a real struggle between bullish and bearish parties. Of course, trading anything is a game between bulls and bears. So consequently, the market pulled back, but then stabilized, followed through Friday, and now today, once again, a peak above it. But the difference today is that there is a close above the 10-day moving average. Let's just review the DBA. The DBA offers exposure to agricultural commodities by investing in futures contracts of wheat, sugar, soybeans, and corn. Prices for all 4 commodities are basically much higher than they have been. Wheat prices have more than doubled in the past year and hit all-time records back in February after the Department of Agriculture forecast a dip in supplies to a significant 60-year low. Soybeans and corn have also reached records recently. Soybean futures prices are nearly double the 2007 average, albeit they're lower than what they were on the highs 6-7 months ago. But nonetheless, all of these agricultural commodities are significantly higher than their previous 5-year trading range highs and lows. So nonetheless, the reasons for the run-up are broad, but they're basically understood. Demand from China, India, and other markets is up because rising incomes are improving. So what you're seeing is these emerging economies coming in with both hands and buying from our or the world's bread basket, which is our grain community. The perfect storm may be the fact that supplies are down, and thanks to worldwide basic challenges and weather conditions around the globe, Brazil, Argentina, and soybean production, you've seen increasing demand and lower supplies overall in the past year to 2. Well, nonetheless, why wouldn't it have gone straight up? Well, nothing goes straight up, and you could see that the market in the spring went higher. I pointed that out in the last video. It came down to a symmetrical double bottom in here, and I said in my last video, part 1 of this DB agricultural ETF analysis, is that I thought that if the market was going to stabilize, that this became a low risk, high return scalping opportunity, as it looks like it's turning out. Let's take a look at another pattern, 3 months on a daily chart. Here I drew the trend line, and now we have what's called a decelerating wedge, that essentially the market has broken out of the apex of this wedge to the upside. It could have very easily rolled down, but there is apparently something going on in demand that's keeping the market buoyant, and today the market closed for the first time above its 10-day moving average since way back here when the market actually broke lower. You can see that as we traveled lower, we did not see any climbs above the moving average and a close. I thought that the market, when it peaked above that average, I said, off these lows and a peak against that moving average told me that the market essentially looked like it was making or trying to put in a bottom. We'll see. There's no guarantees, but I will tell you that I bought this DBA ETF at 24.83. So I'm not boasting. I'm still taking a 13-cent loss, which is no big deal. I had a great day today, and I'm in it for the long haul, believing that the market is putting in a low and will probably achieve this high and then this high in the overall market. And then we'll see. This could be a major challenge to the market, but that has to do with the weather. In any event, I hope this has been of help. One last chart. And this is a chart of a 20 days, but in 2-hour bar charts. And I'm going to show you several resistance levels if you're looking to do something in this contract. First resistance level is 24.80. This is the last high that was made when it peaked above the 10-day moving average. Now remember, this is a 20-day period broken into 2-hour candles. Each candle is a 2-hour period. If we break and swing above this high, the next high will be this high as an objective target, and then the very last high in this past period, which would be 20 days, would be this chart. So technically you've got some overhead resistance, but if we swing through these pivot points here, it's a good chance we're going to see it come into this range over the next week or two, and only time will tell. So I hope this has been of help. I want to thank you very much for your time, and may the best trades be yours for the remainder of the week. Just remember, there's no guarantee that the market can break above this. Look for a break above this resistance or a swing high. I would be a swing trader now and looking for confirmation of a break above that pivot. Thanks very much. Have yourself a great day.